Buy, sell, or hold. Every trader does it. It's always a choice: buy, sell, or hold. In this lesson, you'll learn what to do and why it matters. It may sound obvious. Buy when you believe the price will rise, sell to lock profit or limit loss, and hold if you're uncertain or expect recover. But in trading, timing defines the outcome. So, when do you act? Prices move constantly. To decide, traders use analysis, technical or fundamental. But today, you'll skip the theory and jump right into practice with me. Your first trade. Coca-Cola is trading at $60. Analysts predict a move to $72. Do you take the setup? What now? The stock dipped, then bounced. You're up $2 per share. Many traders exit here, but will you stick to the plan? Your patience paid off. Price hits $72. That's a $12 move. But here's the truth: if you haven't sold, you have no profit. Open trades don't count, as they can flip fast. Only closed trades lock in gains. Great job. You made a $12 profit in under 3 minutes. If only trading were always that simple. But what matters is what you just practiced. Buy, you expect upside; sell, you lock the result; hold, you stay exposed. Knowledge check: match each trading action with what it actually does. Today, you made your first trade decision. You saw a setup, handled the dip, and learned why profits aren't real until they're booked. Next up, the difference between trading and investing. Many confuse trading with investing. Trading is quick and active, investing is patient and steady. By the end of this course, you'll know the difference and why it matters. Let me show you how I think. I'm about the long game, like planting an orchard and waiting for the trees to mature. I want a stable income in retirement, so I decided to plant an apple orchard. It's not a quick process, but once the trees mature, they'll provide fruit year after year with little effort. Meanwhile, my wife Jane has different priorities. She needs money now and isn't willing to wait years for an orchard to grow. Instead, she plants flowers that bloom quickly and can be sold immediately. The apple farmer must wait years for trees to mature, but once they do, they produce fruit every season with minimal effort. This represents investing. Patience leads to long-term, steady returns. The flower grower makes money right away, within weeks of planting. But unlike the orchard, which produces apples year after year, the flower seller must constantly replant to keep earning. Picture this. It's Mother's Day. Demand spikes. Jane sells out in hours. That's high liquidity, something that can be easily turned into cash. Traders depend on it to enter and exit positions quickly. For investors, liquidity affects portfolio design. Your full collection of investments, stocks, bonds, real estate, and even cash. A well-designed portfolio considers not just risk and return, but how easily you can access or reallocate those assets. A market with high liquidity lets traders buy and sell quickly without big price changes. Yes, you're right. If it rains, there will be fewer customers and wilting flowers. That's volatility, unpredictable market swings. Some days the flower market is booming and profits are high. On other days, there are too many sellers or too few buyers, resulting in losses. Knowledge check. Understanding volatility and liquidity. Match each concept with its correct description. Great job. Now let's compare investing and trading. First, investing requires patience. The biggest returns may come after years. The key is compounding, when profits aren't just taken out, but reinvested to generate even more gains. It's like planting new trees with every apple you harvest. Over time, your orchard grows faster and yields more. Investors experience less daily stress. Short-term price swings don't matter as much when the goal is long-term growth. Investors understand that prices can go up and down in the short run, but they stay focused on the bigger picture, building wealth over years through steady growth and reinvested returns. Now, trading, like flower selling, offers fast profits but requires constant effort. Timing matters. Catching the right moment to sell can mean the difference between profit and loss. Traders must stay alert and be ready to act as conditions change quickly. Trading comes with higher risk and higher potential reward. Some trades win big, others don't. Prices can move quickly, and the window to act may be short. That's why traders need to stay focused, constantly analyze, and be ready to execute fast. Knowledge check. Investing versus trading. Match each statement to the correct category. Time for a quick quiz. Not all florists sell the same way. Some sell out daily to avoid spoilage. Others hold stock overnight hoping for better prices. But flowers don't stay fresh forever. Why might a florist sell all their flowers before the day ends? Flowers wilt quickly, just like unsold stock loses value. Selling in a day is always more profitable. Customers only buy flowers in the morning. No, the correct answer was flowers wilt quickly, just like unsold stock loses value. Not quite. Some florists hold overnight, but that adds risk, just like holding trades through market swings. Stocks don't spoil, but their prices can change suddenly when the market is closed. This is called a price gap. For example, overnight news or earnings reports can cause a stock to open much higher or lower than it closed the day before. Some traders sell before the market closes to avoid this risk. Others are willing to hold through it, depending on their strategy. That's why there are different trading styles. We'll learn each one, but for now, remember, day trading means buying and selling on the same day. It requires full focus, speed, and precision. Position trading is more like investing. You hold for months, watch trends, and act slowly. Knowledge check. Trading styles. Match each trading style with its correct description. Which style fits you depends on personality, risk tolerance, and time. Day trading is intense. Swing and position trading are more flexible, but still require attention. By the end of the challenge, you'll understand what suits you best. And remember, your style can evolve over time. That's it for your lesson. Let's recap what you have learned. Trading is short-term, investing is more long-term. Liquidity means how easily and quickly you can buy or sell an asset without affecting its price. Volatility is how unpredictable prices can be, especially important for traders. There are day, swing, and position trading styles. See you in the next quiz. Good luck.